Okay, welcome back. We're continuing our second segment of Mortgage 101. And what I've got up here on the whiteboard is what's commonly referred to as your PITI. And this is basically the makeup of your monthly mortgage payment. It has a couple of different parts. And the P stands for principal. That is the portion of your payment that is going back to pay the bank what you borrowed in order to get that loan. So if you borrowed $100,000, your principal is going to be going back to paying that $100,000 back. Now, the I stands for interest. So that is the cost to borrow that money from the bank. Obviously, we want as low interest rate as possible, but the interest rate that you get is all based upon your risk. If you're a higher risk, then your interest rate is going to be higher. If you're a lower risk, then your interest rate is going to be lower. Now, you might say, well, how do I make my risk lower? Well, you need to have a better credit score. So the higher your credit score is, the lower your interest rate. The lower your credit score is, the higher your interest rate. Or if you put more money down, or if you have good assets or what we call reserves, that can help contribute towards getting a better interest rate. But the two main things is your credit score and the size of your down payment. We also call it in our industry the LTV, the loan to value, how much you're borrowing versus the property is worth. So your principal and interest. Now these two, what I like to call these two are, this is the portion of your payment that is going to repay what you borrowed. Now the next part here is your taxes. This is your property taxes. So what the lender is going to do is they're going to take your total tax bill. Let's just say for our illustration, your annual property tax bill is $3,600. They're going to divide it by 12. So they're going to collect $300 every month as a part of your payment. And that's going to go into an account called Escrow. And I'm going to go ahead and put that on the board here. This is the second portion of your payment, which is your Escrow. So that's just a fancy name for an account that the bank sets up for you. And 1/12 of your property taxes will go into the Escrow. So $300 into your Escrow every month. The next I is your insurance. That's your homeowner's insurance. That protects you in case something unfortunate happens to your house. So if, God forbid your house burns down or there's a storm and a tree falls on your house, this insurance will pay to rebuild the property that is the collateral for the bank. So you have your property taxes and your insurance, and again, the bank is going to collect 1/12 of your insurance, and they'll take that every month. So let's say your homeowner's insurance is $1,200 a month. Well, that means $100 a month in addition to your taxes of $300. So $400 a month is going into your Escrow every single month, and it's going to accumulate over the year. And then as the property tax bill comes due, as the homeowner's insurance bill comes due, they just pay that right out of your Escrow account. You don't have to worry about it. They're taking care of it for you. Now you might ask, well, why does the bank want to do that? Well, the bank is trying to protect their interest in your property as much as possible. If you fail to pay your property taxes, now again, your property taxes, most of it is your local government, so that's helping to pay for schools, infrastructure, all the local government services. So if you do not pay your property taxes, then the local government can put a lien on your property and force it up for tax sale. Well, the lender also has a lien on your house, and they don't want anything to happen to their lien. By forcing it up for tax sale, someone could buy the house out from under you. So they don't want that to happen. Same thing with insurance. If they've lent money on that property and that property burns down and there's no money or no insurance to put the house back together, that's a bad situation to be in. So the lenders want to try to mitigate risk as much as possible. So they're happy to do this for you. They'll set up the Escrow. They will pay your taxes. They'll pay your insurance. Some lenders, not all, but some will even pay you interest on the money that's in your Escrow account, kind of like the interest that you would make on a checking account. They'll do the same thing, but there's very few that do that. Now this last category down here may or may not apply to you, and that's PMI. And we talked about PMI earlier, where again, that's the insurance protection that the banks make you pay if you don't have 20% down. And that helps in case you stop paying on it, the bank has to foreclose. They sell the property at auction or on the market, and they don't get back at least what you owe on the property. That insurance kicks in and pays them the difference. Well, If you have a conventional loan, you're going to have PMI. If you have an FHA loan, that's called MIP. One thing that I may not have made clear earlier is on a conventional loan, your PMI will go away after you've reached that 20% down threshold. On an FHA loan, in most cases, it never goes away. So you're going to have that all the way until you pay that loan off entirely. Now over here I've got written LPMI, and that's another category. LPMI stands for lender paid mortgage insurance. Now the banks aren't going to just pay your mortgage insurance for you out of the kindness of their hearts. What this is they are saying, hey, we'll take care of the PMI, but in exchange we're going to give you a little bit higher interest rate. So what they're doing is they're taking the money from the extra interest that they're making, and they're paying the PMI for you. You might say, well, why would you do that? Well, this used to be more of a tax strategy, and it still could be effective for you. So I would highly recommend you talk to your CPA when deciding which mortgage option is the right one for you. But previously, PMI was tax deductible for households that made less than $100,000. Now, PMI is no longer tax deductible, so this may put more people over here in the LPMI bucket. Think about it this way. If I'm trying to maximize my tax savings, I want to be able to deduct as much as possible from my taxable income. In most cases, the mortgage interest that you pay is tax deductible. For most persons, this is going to be up to $750,000 of your primary mortgage. So if you bought a house or you mortgaged your property for anything $750,000 or less, that mortgage should be tax deductible. Now, disclaimer, I am not a CPA. I don't pretend to play one on TV. So you want to talk to your tax preparer about this, but the mortgage interest is tax deductible. And then previously, PMI was tax deductible for households less than $100,000. Well, if you happen to make good money, you're making over $100,000, or again, today, PMI is no longer tax deductible. If you do LPMI, yes, you're going to get a little bit higher interest rate, but that's all interest. That's all tax deductible, as opposed to only being able to deduct the interest and not the PMI portion. If you move all of it under the interest category, you can now deduct all of that from your taxable income. So again, talk to your financial CPA, tax preparer, get their opinion on this, but this could be a way to maximize your tax savings benefit. So here we have it. You have your principal, your interest, taxes, insurance, possible PMI or MIP. That equals your total payment, or your PITI. Some people call it the PITI. But I hope you found this information helpful. If you're still not sure about which program is the right one for you, or you have some follow-up questions, again, feel free to reach out via text, by email, by phone. All of that contact information is down below.